Hi everyone, today I'm going to talk about Tether. Now, a lot of you have been worried about how will Tether impact Bitcoin? Will Tether lead to a collapse in the price of Bitcoin? Is it this structural problem? Well, today I'm going to go through and explain to you how Tether works, how markets work in crypto, and how Tether isn't that big of a concern. It's really not this big deal that everyone's making it out to be. I've been around for 8 years, and the Tether worries and concerns have been around for 5. It's not as big of a deal as people make it out to be. Yes, there are some issues with it, but is it going to devastate Bitcoin? No. All right, so let's go dig in. I wrote this article on Thursday. It's called Don't Fear Tether. On Thursdays, I write a new publication every single week. It's called the Held Report. And so if you want this first, subscribe, and I'll add this in the description. Just subscribe to my newsletter. It comes out on Thursdays. And if you watch this, you're getting it a couple days later. But without further ado, let's dig in. Okay, so what is Tether? Tether is what it is it represents a dollar that's been wired into a bank account of this company called Tether, and Tether issues a digital version of the dollar called USDT, T standing for Tether. What this enables traders to do is you can utilize Tether as a substitute dollar. Instead of having a real dollar, now you've got an equivalent version of that, which enables a lot of different exchanges and different traders who don't have access to dollars to utilize a dollar substitute. And, before I go any further, I just want to say that this Tether FUD is not out of the ordinary. I've seen 3 market cycles, the 2013, 2017, and current market cycle, and concerns around different things, whether it be Tether, different types of trading bots, Bitcoin's using too much energy, Bitcoin's used by money launderers and drug dealers. All of this has been around as long as I can remember. There's a funny quote that I love here. The amount of energy needed to refute bullshit is an order of magnitude larger than to produce it. And with a lot of this stuff, people go, oh, well, just show me this and that'll prove it to me. Oftentimes, you'll find that most people don't really want to dig in on the nuances. I do want to note here, I'm not defending Tether, Bitfinex. I'm just diving into the overblown concerns around it. I think the companies have done some shady things over the years, and I'm not vouching for them as a place that you should go trade. Okay. Purpose of Tether. So we already covered that. It's used as a US dollar substitute. Trading firms like it because it's a really fast way to complete the fiat leg of an arbitrage or market making opportunity. Banks close. Well, Tether never closes. It's a digitized version of the dollar that operates on a blockchain to where you don't have to worry about that. So it's really efficient for trading activities. And then if Tether breaks its peg, both these trading firms and Tether, the company, operate as a way to ensure that the peg is correct. So the peg stands for 1 Tether should equal $1 on average. Now, the markets trade a little bit differently than that, to where there's a small pricing discrepancy. These firms and Tether can arbitrage that difference, so take advantage of the pricing difference. For example, taking Tether and then redeeming it for US dollars and vice versa. Okay, so how do crypto markets work? A lot of people here probably don't even understand how regular trading markets work. These are all the same thing, whether it be stocks, bonds, or crypto. So the base asset is called the base asset is traded on something what's called a spot exchange. Exchanges like Coinbase, Kraken, and Binance. And there's a variety of different ways for traders to fund their account in order to buy Bitcoin. They can use fiat, US dollars, euros, yen, pounds, crypto native assets, so they could trade Tron or Litecoin for Bitcoin, or they could use stable coins, Tether USDC, which is created by Coinbase and Circle. So that's how people fund their accounts in order to buy Bitcoin. There's another type of financial instrument called a derivative. Now, derivatives are trading on the underlying asset, the Bitcoin itself. These are speculations as to price movement, and those are represented by futures and options. Kraken, for example, has futures, but we don't have options. Coinbase has neither, and Binance has both options and futures. Now, whenever you trade any of these types of financial instruments, you place a trade on an order book. And what that looks like is this here, and this is a company called CryptoWatch, a subsidiary of Kraken, and it's a really great way. It's probably the best visualization I've ever seen of an order book. The order book is on the far right side. Then we've got the vertical visual book here, and we've got the price chart here. These candles, these green and red lines, represent 3-minute intervals. Now, as you notice when I mouse hover over the order book on the far right, the vertical visual book, this one, and the chart on the left here, they have you see those 2 horizontal lines. What those represent, and if we look at the far right, so we look at where my mouse is hovering, That's the price of $32,500 per Bitcoin. What that represents is that there are 111 Bitcoins that are willing to be sold at that price. And then there's 84 Bitcoins willing to be sold at 32,400, 8 Bitcoins willing to be sold at 32,300. And then on the right here is the culmination or the sum of those functions. So that's 7 plus 84 plus this. So it's all three of these combined. And what really is really cool about the vertical visual book, the right here and over here, is that when I mouse hover, it shows me how much slippage will occur. There are only so many buyers and sellers at any given price. So up here are the sellers. On the bottom here are the buyers. And there's only so much Bitcoin that are willing to be bought or sold at any given price. And the white horizontal lines here show you what the slippage would be if you were to buy all of that Bitcoin or sell all of that Bitcoin. So all of these orders represent the aggregate market's belief in what Bitcoin is worth. Buyers came and posted these different amounts that they'd be willing to buy at, and the sellers came and said, we'd be willing to sell at this value. That's why it's called an order book. It's a book of all sellers and buyers. Now, these markets are huge. At Coinbase alone has 43 million customers. Kraken has millions of customers as well, and Binance has a huge number too. So the crypto market is a ton of volume. I mean, tens of billions of dollars traded daily in Bitcoin, of probably like 10 to 100 million traders. Now, crypto trades 24/7, unlike traditional markets, which have weekends off and holidays off. What's really unique about crypto assets is that price discovery occurs on multiple exchanges simultaneously. Price discovery is the process of buyers and sellers coming together and going, cool, I'll sell you this Bitcoin at this value. And the buyer goes, great, I'll buy it from you at that value. So, with traditional equities, you've got like the New York Stock Exchange, and that is the one exchange venue in which price discovery occurs. There's a lot of different brokerages that you trade with that eventually have the order routed to the exchange, but that's the exchange order book right there. With Bitcoin, we don't have that. There's no central venue. There's many venues like myself, like Kraken, Coinbase, and Gemini, and Binance, where the price is being discovered. Buyers and sellers are coming together to trade it. And this leads to some interesting moments when there's actually a discrepancy in the prices. So in 2013, there was the Mt. Gox. There's the Mt. Gox versus Bitstamp premium. Let me see if I can find that here. Yeah, here we go. Okay, so yeah, the Mt. Gox premium is increasing. So this is back from 2013, where we can see that there's a price difference between the price of Bitcoin on Gox versus BTCE and Bitstamp, which were the popular exchanges at the time. That was due to, for example, like regulatory limits and where Mt. Gox lost their banking relationship. So people bid up the price of Bitcoin. They took their dollars, bought Bitcoin so they could get their Bitcoin out of Gox because they couldn't wire money out because Gox had lost their banking relationships. There's also the Kimchi premium. Kimchi premium was the delta between South Korean exchanges and other exchanges. That was due to arbitrage. This was trying to be arbitraged away because these arbitrage opportunities exist, but the arbitrage was hard to close due to regulatory issues, where the South Korean government didn't allow certain folks to open up Korean bank accounts. So, and then Coinbase as well. So Coinbase, this is back in 2017. GDAX was the former version of the Coinbase Pro name. But GDAX actually had a spread where they were a couple $100 higher than other exchanges because the demand to buy Bitcoin there was higher than elsewhere. So this is a good thing. What this means is that no exchange, no one central exchange, no one fiat or other crypto asset controls the price of Bitcoin. The price is being discovered all over the world, billions of dollars in every single exchange, and that's done with pounds, euros, yen, dollars, and other crypto assets. Tether is one part of that, where Tether is being sold to buy Bitcoin. There's so many other currencies that are used for that as well. So let's go ahead and tackle some of the claims here. Tether represents an unhealthy portion of BTC volume. So many people read the Bit Short, this article, which was a really poorly written article by someone who doesn't understand at all about how markets work. For example, they didn't know the difference between spot and derivative exchanges. And, what's pretty wild about that is that, let's see, I'm trying to find the article here. Yeah. So between spot and derivative exchanges, what happens is we have, So Kraken did an analysis where we looked at different exchange volume, and we looked at, so here we go. there was 4.6 times the amount of derivative volume than spot volume. So this is important because it really highlights how silly this argument was, that in this article, they were looking at these flows, but they weren't looking at spot flows, the underlying flows. They were looking at all the derivative flows as well, which is nuts. That's not at all what's going on. And so, yeah, you can download this report. It's The Tail Wags the Dog. And so they dig into why, there's a higher amount of derivatives volume. In the traditional financial markets, this is the same thing as well. We see the same thing occurring. Bitwise, a really well-known company in the crypto space, did an analysis over exchange volumes. You can read that here. So bitcointradevolume.com, where they looked at how much volume is fake. So a huge portion of Bitcoin trading volume is faked. Simply they add zeros to the number or trade it back and forth at 0% fees. But what that occurs typically in is USDT. So a lot of Asian exchanges use USDT because they don't have access to US dollars, and a lot of them fake their volume in order to look more liquid to attract more traders. And that's where you see these Tether numbers just get really crazy, but the actual Tether volume is much lower. Now, when we look at the price of, or the market cap of Bitcoin, which is 604 billion, versus the market cap of Tether, Tether is tiny. It's a very small portion of Bitcoin's market cap. And that means that it represents a very low risk to, hurting Bitcoin. And that's where, I don't know who remembers BitConnect, but BitConnect was an outright scam in the crypto space back in 2017 that had a market cap of 2.6 billion, which collapsed to zero. Did that impact the price of Bitcoin? Not really. Bitcoin keeps chugging along. Bitcoin doesn't care. Here's Ethereum priced in Bitcoin. As we saw, Ethereum priced in Bitcoin collapsed. Bitcoin didn't collapse. Then we have XRP. The price of XRP in Bitcoin collapsed multiple times. Bitcoin is fine. These are things that people need to realize, that the value of other assets that are traded into Bitcoin collapse all the time. And so I think that one, the idea that like it represents an unhealthy portion of BTC volume is not only incorrect, but just really misled. The next one is that Tether is fractional reserve, not audited. Now, there is some legitimacy to this claim. We do know that Tether was partially backed for a period of time when Bitfinex borrowed $850 million to cover a hole. So they had funds that were fraudulently taken from them, and they borrowed. So Bitfinex borrowed money from Tether because the two companies are intertwined, and so that is very a legitimate concern, because Tether wasn't fully backed for some time. Now, this actually had a very, very small impact on the price of Bitcoin. This was back in April 2019. When that happened, the price of Bitcoin dropped 20%, but the day it closed, with the day only having a drop of 10%. So where here do you see that Tether was unbacked 1-to-1? I don't know. It all looks pretty normal, right? No giant collapse, no seismic collapse of Bitcoin when people felt that Tether was unbacked. This is the moment right here, this little wick. And that represents an intraday 20% drop, or it represents an immediate 20% drop and only an intraday drop of like 7 to 10%. And then a few days later, Bitcoin skyrocketed. So basically, Bitcoin doesn't care. Bitcoin doesn't care about if Tether's backed or not. For example, in the article, the Doomsday Machine article, they also made other dubious claims that the aggregate USD held in Bahamian banks is greater than all the USD held in the Bahamas. But it's not all held in the Bahamas. It's held in correspondent banks. And this is a tweet by Sam from Alameda, also known as FTX. They're one of the largest exchanges in this space. Sam has a background in like quant hedge fund trading. And he also actively participates. In this next section, we do have proof that wires are made in and out of Tether's banking partners, and that people have taken Tethers and redeemed them for dollars, and people have taken dollars and received Tethers, which includes Sam. So Sam goes, I don't know what to tell you. We can and we do. There's also folks like Dan, and I don't know how to pronounce his last name properly, so I'm just going to skip that. But Dan used to work at Circle OTC, the largest OTC desk in this space. They also redeemed billions in Tether. And then what Bitcoin did, this is one that was done very recently, like a couple of weeks ago, where Peter sat down with the CTO and chief legal counsel of Tether to dive in on different questions. So we've got a lot of evidence, a lot of proof that people have wired money in and out. They've redeemed tethers for dollars. So I think, yes, there is some legitimacy to the concern that it's fractional reserve. However, we've seen it maintain its peg. When it was fractional reserve, it had a very little impact on Bitcoin. And then finally, around, people worry about like an audit, right? Or people are concerned that there's no audit. Well, no Big Four accounting firm wants to touch this shit. It's not worth the amount of headache there's no fee that's worth the headache for them to go dig into this and go, we stand by these numbers. So it's a bit of a chicken and egg problem. They can't get audited, but because they can't get audited, then other people don't want to audit them. One last thing. What's funny about Tether being fractional reserve is that the existing banking system is fractional reserve. So I guess are people worried that dollars are pumping up Bitcoin? It kind of is. Bitcoin has a 21 million hard cap. Dollars have infinity. There is no hard cap. So dollars are being printed, and that pumps the price of Bitcoin. It's not a bad thing. It's just exactly how the existing fiat system works. And then how about altcoins? There have been 10,000 altcoins created, and they're constantly ones being created over time, and they are traded against Bitcoin, and they're literally printed out of thin air. No one worries about that. Finally here, if Tether was found to be worthless tomorrow, let's say none of them were backed, what would happen to the price of Tether? Well, it would go down to zero. And people would take that Tether and they'd buy Bitcoin because it actually owns something that they don't have to trust anyone else with. So what we'd see is the price of Bitcoin going up while the price of Tether is going down, which Jesse from the Kraken Exchange also said this as well. Tether losing value versus USD does result in BTC going up. For example, like as the US dollar BTC or USDT peg, or USDT BTC pair goes up in value, arbitrage bots look at that, and USD versus BTC would go up. So it's all very much intertwined and not that big of a deal. Now, finally, if regulators did put pressure on Tether's banking relationships, which they have before, and let's say they shut down their bank account or froze those funds, it would likely continue to trade just like Mt. Gox did. So in Mt. Gox, when Mt. Gox lost its fiat banking wires and it had all these different issues, what was crazy is that there's actually a company called Bitcoin Builder, which allowed folks within Mt. Gox to trade Mt. Gox coins that were frozen. And so there would be a secondary market that would pop up. All right, another claim, Tether is used to pump Bitcoin. This is probably the most popular one, that Bitcoin's price action, there's no way that Bitcoin could have done this organically, has to be manipulation. Well, I've been around for 8 years, and this isn't the first time I've heard this. Okay, 2013. People worried about something called a Willy bot. Sorry, it's 2013, 2014. People worried about Willy bot. That Willy bot was used by Mark Karpelès, the CEO of Mt. Gox, to artificially pump up the price of Bitcoin. Well, hate to break it to you, but there's no bot in the world that can make everyone in the world believe that Bitcoin is valuable. Yes, there was a bot, but how much of an impact did it have on the price? People don't know. It's pretty much negligible. Again, the price is being discovered across multiple exchanges. No one's forcing people on Bitstamp or BTC at the time to buy Bitcoin at all. And so it's a pretty ridiculous sort of argument. And then in 2017, we had the same argument, but a little different flavor though. So this is the first time that Tether came around by this account named Bitfinex. And he had grown resentful that Bitcoin had risen after he sold all of his coins. And another bot here. So this is the first time that Tether FUD comes around. The other bot was called Spoofy. So Spoofy was, and this is why I covered order books earlier. This guy literally didn't know how order books worked. And he looks at like order book activity going on where he sees large orders. And he claims that that's being used to long-term impact the price of Bitcoin. Sure, people are allowed to place large and small orders, and who knows how that impacts the market on a day-to-day or a minute-by-minute basis. But you certainly can't manipulate the entire market over time by just placing like large limit orders. It's a pretty ridiculous claim. And then I think kind of what really got all this into like a perfect FUD state for Tether was this research report, is Bitcoin really untethered, by two researchers at the University of Texas. All right, so these two idiots violated the most the most basic principle of research, which is that like correlation does not equal causation. Umbrellas don't cause rain. And if you look at there's a funny website called Spurious Correlations by Tyler Vigen, where he looks at very funny correlations, but they're not causations, where he looks at, for example, the number of people who drowned by falling into a pool is correlated with films that Nicolas Cage appears in. It obviously has no causality. Nicolas Cage is not causing people to drown in pools. It's simply a random correlation, similar to Tether. Tether is utilized by the market to be that efficient function of a digital dollar. More dollars go into Bitcoin as the price goes up because people are taking dollars. If you were to look at wire volumes, more wires are going into Kraken and Coinbase as the price of Bitcoin goes up. It's not pumping the price of Bitcoin. Dollars are just used to buy Bitcoin. Nick Carter had a really funny take on this where he goes, USDC issuance causes the price of Bitcoin to increase. He's being sarcastic here. No one worries about USDC, and USDC is a stable coin because it's obvious that people have to wire money into USDC, and that's used to facilitate that digital dollar. It's not that it's pumping the markets. It's literally just how markets work. So there's not really any evidence at all that Tether has any evidence of like creating Bitcoin's price, Bitcoin run up. What's funny here too is, okay, so let's, so people first complained that Tether caused the 2017 price run up. Okay, so Tether's used to pump the price of Bitcoin in 2017, but then they selectively decided not to pump it here. Oh, but then they pumped it a little bit here, not here, and then here. I mean, it's ridiculous. The idea that like Tether, which is a small fraction of the volume and of the market cap in the space, is somehow selectively used to pick and choose moments where they pump. I mean, it's ridiculous. All right. Well, so now that we've fully debunked how Tether interacts with Bitcoin, what does Tether actually impact? I think Tether has a bigger risk to DeFi. So in DeFi, primarily being on Bitcoin, being on Ethereum, it relies on collateral to make it all work. This collateral could be crypto-native assets like ETH, ERC20 tokens, other wrapped cryptocurrencies like WBTC, and I need to put a W in there, and then fiat stablecoins, Tether, USDC, or algorithmic stablecoins like Make or Die. So both Tether and USDC are centrally controlled. So USDC froze $100,000 on chain. These stablecoins, USDT and USDC, are not. They're stable, but they are not permissionless. They can be frozen in any moment at any time, and this happens frequently. So here's an example of the $100,000. And then, so what this really represents, though, when it comes to DeFi, is DeFi operates on the principle that this collateral is permissionless, that it can't be frozen. And smart contracts are increasingly relying on these centralized stablecoins to be collateral. And that's crazy because like as soon as these funds are frozen, that can lead to a cascading effect between the different smart contracts that relied on the other smart contract relying on the other smart contract. Kind of a house of cards situation. And Flipside Crypto did a really good analysis of looking at how Tether has increasingly become part of the ecosystem. So on the right here are different like DeFi protocols. And green is the number of like Tether transactions that are occurring between different counterparties in the centralized exchange space. So like on the left are like centralized exchanges. On the right is DeFi. And we've seen that DeFi has gone from almost no Tether activity to a ton of it. And this represents a huge systemic risk to DeFi. Now, there was another analysis done where they looked at how much volume is done in different types of stablecoins. So when we look here, USDT and USDC, a large percentage of stablecoin collateral is in these assets, which are centralized and totally seizable, totally controllable, versus DAI, which is a decentralized stablecoin, or what they would call an algorithmic stablecoin. So if USDT goes to zero, it causes a huge amount of daisy-chained explosions that occur in the DeFi landscape of like different collateral blowing up. And that's where I think like, let's see. Oh yeah, this is the last part here. So that's where Bitcoin, I think Tether's threat to Bitcoin isn't that big of a deal. To DeFi, it represents a bigger one, but Bitcoin has survived much worse scenarios. In its relatively short 12 years of existence, it has survived the Silk Road getting shut down, Mt. Gox being hacked multiple times and shut down, other exchange hacks. 12 exchange hacks happened in 2019 alone. 43 exchange shutdowns, Crypsy, Quadriga. Most people don't even remember these because it's been so long ago, but like Bitcoin has survived massive structural issues with the trading architecture around Bitcoin. There's a Bitcoin civil war, Bitcoin versus Bitcoin Cash, Bcash, which included some of those wealthy Bitcoiners and mining manufacturers. Bitcoin is banned by China FUD, regulatory crackdowns, etc. Bitcoin has survived all of this. Tether isn't going to cause Bitcoin to enter a bear market. It's one of many assets that trade against Bitcoin. We've seen Bitcoin survive much worse, and Tether concerns are way overblown. Bitcoin is stronger than ever. And that's where, COVID really brought the focus of Bitcoin and why it's valuable as a store of value into this world. And because of that, a new wave of market participants started to buy the institutions. And they're bringing $100 trillion of what they manage in and taking part of that and investing that in Bitcoin. So Bitcoin's price isn't just randomly pumped by Tether. Bitcoin's price is going up because during COVID, governments printed almost unlimited money here to deal with the financial issues. Bitcoin only has a 21 million hard cap, and the world is waking up to that realization that they need to store value in something that isn't going to lose purchasing power. While their government is devaluing their currency, they're going to something else that's much stronger, which is Bitcoin. That makes sense. That's exactly what's happening. It's not this artificial thing that Tether's pumping it. And then, Bitcoin in this bull run is really interesting too, because there's a singular narrative in the space. Bitcoin's gold 2.0 narrative, that Bitcoin's the new store of value. Back in 2017, you had other competing narratives like ICOs and World Computer and whatnot. But now, that's totally changed. And then finally, you can buy Bitcoin with PayPal, Robinhood, Cash App, SoFi. There's so many different places to buy it to where, is the price caused by a Tether pump, or is it caused by hundreds of millions of Americans and other people across the world being able to buy Bitcoin much more easily than before and understand it, and also having the macro backdrop of COVID and really highlight Bitcoin's value prop for the world. Bitcoin was made for this moment. Don't be scared of a little bit of FUD. You're going to encounter a lot more FUD along the way. Government's banning it. Bitcoin boils the oceans, everything else. Tether's just one of those. It's not as big of a deal as people make it out to be. And so don't worry about that. Don't freak out and panic sell your portfolio. Be smart, hodl, and you'll get through this. Hope everyone enjoyed. Cheers.